Sarah Chen stared at her phone at 3 a.m., watching her portfolio drop by 42%. 48 hours earlier, she'd felt confident, secure. Now, $17,000 had evaporated. Her hands shook as she scrolled through Reddit forums and Twitter feeds, desperately seeking answers. Everyone had a theory. No one had real answers. This wasn't supposed to happen, not this fast, not this brutally. Sarah's story isn't unique. It's the story of millions who've watched crypto fortunes appear and vanish like digital ghosts. Why is crypto so volatile? It's the question that haunts every investor who's experienced a gut-wrenching price swing. The internet overflows with explanations, theories, and confident proclamations. Most of them are myths, comforting stories that feel true but miss the actual mechanisms driving these wild price movements. Today, we're breaking down the 5 biggest myths about cryptocurrency volatility and revealing what's really happening beneath the surface. The truth is more complex, more fascinating, and more important than the myths suggest. Myth number 1: crypto is volatile because it's purely speculative, with no real value. This myth appears everywhere, from financial news to dinner table conversations. It suggests crypto prices swing wildly because the assets are essentially worthless digital air that people trade based on hype alone. Sarah believed this myth after her losses. It explained everything neatly. Too neatly. The reality? Yes, speculation drives volatility, but so does speculation in oil, gold, and tech stocks. The question isn't whether speculation exists, it's why crypto speculation behaves differently. Bitcoin's market capitalization exceeds $500 billion. Ethereum hosts thousands of decentralized applications processing billions in real transactions. To call this pure speculation ignores measurable utility and adoption. The myth crumbles when you examine market structure. Crypto markets are young. Bitcoin launched in 2009, making it barely 15 years old. Compare that to equity markets with centuries of regulatory frameworks, institutional participation, and price discovery mechanisms. Young markets are volatile markets, regardless of their underlying value proposition. Early stock markets experienced similar volatility. The Dutch tulip mania of the 1630s saw prices swing by hundreds of percent. Early oil markets in Pennsylvania during the 1860s witnessed daily price swings that would make crypto traders blush. Gold prices fluctuated wildly before market structures matured. The difference isn't speculation versus legitimacy, it's market maturity, infrastructure, and the time required to build stabilizing mechanisms. Crypto is living through its volatile adolescence in public, broadcast in real time across global digital networks. Myth number 2: a handful of whales manipulate prices at will, creating artificial volatility. This myth feels satisfying. It assigns blame to shadowy figures moving markets for profit. The whale theory suggests that large holders coordinate to pump and dump prices, trapping regular investors. There's truth here, but it's incomplete and misleading. Yes, concentrated ownership exists in crypto. Yes, large transactions can move markets. But whale activity explains only a fraction of crypto's volatility, and the myth dramatically overstates their control. Bitcoin whale addresses, those holding more than 1,000 coins, control approximately 40% of supply. That sounds concentrated until you compare it to traditional assets. The wealthiest 1% of Americans own roughly 50% of all stocks. Wealth concentration isn't unique to crypto, it's a feature of capitalism. More importantly, whale transactions are transparent on blockchain. You can watch large movements in real time. This transparency creates perception bias. Every large transaction feels like manipulation because it's visible, unlike opaque traditional finance transactions. The actual driver isn't whale control, it's liquidity fragmentation. Crypto trades across hundreds of exchanges globally, 24 hours daily, with no central clearinghouse. When a large order hits a low liquidity exchange, it creates price impact that spreads through arbitrage. The same transaction on a mature stock exchange would barely register. It's not manipulation, it's market structure. Whales can influence prices, absolutely, but they can't sustain artificial prices against market forces. Every pump eventually meets dump pressure. Every manipulation attempt risks capital. Myth number 3, crypto is volatile because it's completely unregulated, allowing chaos to reign. This myth gained momentum after high-profile collapses and frauds. The logic seems sound: no rules, no stability. Traditional markets have the SEC, CFTC, and central banks providing oversight and stability mechanisms. Crypto, the myth suggests, has nothing. But this fundamentally misunderstands both crypto's current regulatory state and the relationship between regulation and volatility. The truth complicates the simple narrative of lawless digital frontiers. Crypto isn't unregulated, it's differently regulated across jurisdictions. The United States applies existing securities laws, requires exchange registration, enforces anti-money laundering rules, and prosecutes fraud. Europe implemented MiCA regulations. Japan licensed exchanges years ago. Singapore, Switzerland, and dozens of other nations have comprehensive frameworks. The issue isn't absence of regulation, it's regulatory fragmentation and uncertainty. Different rules in different countries create compliance complexity, but they also create regulatory arbitrage that can amplify volatility when capital flows seek favorable jurisdictions. Counterintuitively, regulatory announcements often increase volatility rather than reducing it. When China banned crypto mining in 2021, Bitcoin dropped 30% in days. When the SEC approves Bitcoin ETFs, prices spike. Regulatory clarity is stabilizing long-term, but regulatory events create sharp volatility as markets reprice risk and access. Traditional markets experience similar dynamics. Dodd-Frank, circuit breakers, and central bank policy changes all generate volatility. The difference is crypto markets are smaller, younger, and more sensitive to regulatory shifts that change the fundamental business models. Myth number 4. Crypto prices swing wildly because there are no fundamentals to anchor valuation. This myth appears in every market downturn. If you can't calculate earnings, revenue multiples, or discounted cash flows, the argument goes, then prices float untethered to reality, bouncing randomly based on sentiment. Sarah heard this from her financial advisor after her losses. It sounded authoritative and damning. But it fundamentally misunderstands how valuation works for network technologies, commodities, and emerging asset classes. Bitcoin and Ethereum have measurable fundamentals, they're just different fundamentals than equities. Bitcoin's hash rate measures network security. Active addresses track user adoption. Transaction volume indicates economic activity. Network fees reflect demand for block space. Ethereum's total value locked measures defy usage. These metrics correlate with price over time. They're network fundamentals, similar to how internet companies were valued on user growth before profitability. The challenge isn't absence of fundamentals, it's that markets are still discovering which fundamentals matter most and how to price them. What drives volatility isn't lack of fundamentals, it's uncertainty about how to value them. Should Bitcoin be valued like gold, a currency, or a payments network? Is Ethereum worth more as a settlement layer or as a platform for applications? These questions have multiple defensible answers, creating a wide range of fair value estimates. When new information arrives, a technological upgrade, a competitor's innovation, a regulatory clarity, the market dramatically reprices as participants update their valuation models. Traditional assets faced similar uncertainty during their emergence. Myth number 5. High volatility proves cryptocurrency is failing as money, technology, and investment. This myth conflates volatility with dysfunction. If crypto were succeeding, the logic goes, prices would stabilize as adoption grows. Continued volatility signals that crypto hasn't achieved its promises and may never do so. This myth caused Sarah to exit her positions at the bottom, locking in losses. She believed the volatility itself was evidence of fundamental failure. But volatility and success can coexist. In fact, they often must. Amazon stock dropped 95% during the dot-com crash. Tesla has experienced multiple 50% corrections during its ascent to becoming the world's most valuable automaker. Apple, Google, and Microsoft all endured periods of extreme volatility while building trillion-dollar businesses. Volatility during rapid growth and technological transformation is normal, even expected. It reflects uncertainty about future outcomes, shifting competitive landscapes, and the difficulty of pricing revolutionary change. Crypto exhibits similar patterns, compressed in time and amplified by global 24/7 markets. Growing adoption can actually increase volatility in the short term. As crypto reaches new user cohorts, institutional investors, retail traders, sovereign nations, each group brings different motivations, time horizons, and risk tolerances. Their entry and exit create volatility as the market absorbs diverse capital flows. El Salvador adopting Bitcoin as legal tender created volatility. Bitcoin ETF approvals created volatility. Each milestone represents success, yet each generates price swings as markets incorporate new participants with new behaviors. Stability emerges from maturity, not achievement. So if the myths are wrong, what actually drives crypto's extreme volatility? The answer is structural, not speculative. First, limited supply meeting explosive demand growth creates price discovery chaos. Bitcoin's fixed 21 million supply can't respond to demand like commodities can increase production. Second, 24/7 global markets without circuit breakers allow cascading liquidations. Third, leverage traders routinely use 10 to 100 times leverage, amplifying every price move. Fourth, thin liquidity across fragmented exchanges magnifies price impact. These structural features interact to create volatility that dwarfs traditional markets. Leverage deserves special attention. Platforms offer up to 100 times leverage on crypto futures. This means a 1% price move can liquidate entire positions, forcing automated selling that drives prices further down, liquidating more positions. The 2021 flash crashes saw billions in liquidations within hours. Traditional equity markets limit leverage and have circuit breakers to stop cascades. Crypto markets operate continuously with minimal protection mechanisms. This isn't a bug or conspiracy, it's a deliberate design choice prioritizing open access and continuous operation over stability. Crypto markets suffer from severe information asymmetry. Insider information, exchange front-running, and opaque market making create advantages for sophisticated players. When a major exchange lists a new token, insiders know first. When a protocol plans an upgrade, developers know details before announcements. When large orders arrive, exchange operators see order flow that retail traders cannot. This information inequality creates sudden price movements as informed traders act on knowledge others lack. Traditional markets have similar issues, but decades of regulation have reduced the gaps. George Soros's reflexivity theory perfectly describes crypto markets. Prices influence fundamentals, which influence prices, creating feedback loops. When Bitcoin price rises, mining becomes more profitable, attracting hash rate, increasing security, making Bitcoin more valuable, driving price higher. When price falls, miners capitulate, security decreases, confidence drops, price falls further. This reflexive relationship between price and fundamentals creates oscillation and overshooting in both directions. Traditional assets exhibit reflexivity, but crypto's direct connection between price and network security amplifies the effect. Crypto markets exhibit unstable correlations with traditional assets, creating unpredictable behavior. Sometimes Bitcoin correlates with tech stocks, suggesting risk-on sentiment drives it. Other times it correlates with gold, suggesting safe haven dynamics. Sometimes it correlates with nothing, moving independently. This correlation instability means diversification strategies fail unpredictably. A portfolio that seemed balanced becomes concentrated when correlations suddenly shift. Traditional assets maintain more stable correlation patterns, allowing reliable hedging. Crypto's shifting identity, currency, commodity, technology, speculation creates correlation chaos. Social media amplifies sentiment-driven volatility beyond anything traditional markets experience. A tweet from Elon Musk moves Bitcoin by 10%. Reddit forums coordinate buying pressure. Crypto Twitter creates echo chambers where narratives spread virally. Fear and greed propagate at internet speed, reaching global markets simultaneously. Traditional media takes hours or days to disseminate information, social media takes minutes. This acceleration compresses price discovery into violent spikes and crashes. The same social dynamics driving volatility also enable rapid information sharing and community coordination. 6 months after her losses, Sarah cautiously returned to crypto. But this time was different. She understood the structural forces driving volatility. She recognized her previous beliefs as myths that had made her vulnerable. She sized positions appropriately, knowing volatility was feature, not bug. She stopped checking prices hourly, understanding that short-term swings reflected market structure, not fundamental failure. Most importantly, she stopped personalizing price movements. They weren't happening to her, they were happening in a young market finding its way toward maturity. Crypto markets are evolving toward stability, but evolution takes time. Bitcoin's volatility has decreased over its 15-year history, though it remains high by traditional standards. Institutional infrastructure, custodians, derivatives, ETFs gradually stabilizes markets. Regulatory clarity reduces uncertainty premiums. Increased liquidity dampens price impact. Market making improves. These changes work slowly, generationally. The volatility that seems extreme today will seem quaint in 20 years, just as early stock market swings appear absurd now. Understanding this timeline prevents mistaking immaturity for dysfunction. At 15 years old, Bitcoin is younger than Google, Facebook, or Amazon were when they faced existential questions about sustainability. The New York Stock Exchange took decades to develop stabilizing mechanisms after its 1792 founding. Options markets needed years after 1973 to mature. Commodity futures required generations to stabilize. Each comparison reveals the same pattern: new markets are volatile markets, and volatility decreases with infrastructure, participation, and time. Crypto isn't uniquely dysfunctional, it's uniquely visible in its youth. The crypto ecosystem has already created partial solutions to volatility. Stablecoins, cryptocurrencies pegged to dollars or other assets, provide volatility refuge while maintaining blockchain benefits. Circle's USDC and Tether's USDT process hundreds of billions in transactions, offering stability for traders and users who need predictable value. Decentralized stablecoins like DAI attempt algorithmic stability. These innovations acknowledge volatility as a problem worth solving while preserving cryptocurrency's core attributes. The existence of stablecoins proves the market recognizes and addresses its own volatility. Sophisticated derivatives markets now enable volatility hedging that was impossible in early crypto years. Options allow traders to protect against downside while maintaining upside. Futures enable price locking for businesses. Perpetual swaps provide continuous hedging. The Chicago Mercantile Exchange offers regulated Bitcoin futures. These tools don't eliminate volatility, they redistribute it to participants willing to bear it in exchange for premium. As derivatives markets deepen, volatility increasingly becomes a choice rather than an unavoidable exposure. Volatility creates opportunity for disciplined strategies. Dollar cost averaging, investing fixed amounts at regular intervals, exploits volatility by buying more when prices are low and less when high. Sarah adopted this approach on her return. Instead of trying to time the market or reacting to swings, she invested the same amount monthly. Over time, volatility worked in her favor, smoothing her entry price. The same volatility that destroyed her panic-driven trading enhanced her systematic approach. The difference wasn't the market, it was the strategy. The fundamental rule for volatile assets: size positions so that maximum realistic loss doesn't change your life. If Bitcoin can drop 50%, invest only amounts where a 50% loss is acceptable. This seems obvious, yet most crypto losses come from violating this principle. Leverage amplifies position size beyond sustainable levels. FOMO drives oversized commitments. The mythology around crypto riches encourages all-in thinking. Sarah's original mistake wasn't buying crypto, it was allocating money she couldn't afford to lose. Volatility only destroys when position sizing ignores it. Volatility's impact depends entirely on time horizon. For day traders, crypto's volatility creates opportunity and danger in equal measure. For long-term holders with 5+ year horizons, short-term volatility becomes noise. Bitcoin has never been lower than its price 4 years prior at any point in its history. This doesn't guarantee future performance, but it illustrates how time horizon changes volatility's meaning. Traditional investors understand this: stocks are volatile short-term, stable long-term. The same principle applies to crypto, amplified by the asset's youth. Institutional adoption is gradually reducing volatility through deeper liquidity and professional market making. BlackRock's Bitcoin ETF, Fidelity's custody services, and Goldman Sachs's crypto trading desk bring institutional capital and infrastructure. These players use sophisticated risk management, provide consistent liquidity, and dampen extreme moves. Their participation doesn't eliminate volatility, but it reduces the severity of swings by absorbing shock and providing stabilizing capital. The transformation from retail-dominated to institutionally balanced markets takes years, but the process is underway. Sophisticated investors view volatility not as noise but as information. Extreme price movements signal changing fundamentals, shifting sentiment, or emerging risks. A sudden volatility spike might indicate regulatory news, technological breakthrough, or security concern. Rather than fearing volatility, informed participants decode it. What caused this move? Which participants drove it? What does it reveal about market structure or fundamentals? This analytical approach transforms volatility from enemy to teacher. The market speaks through price movement, volatility amplifies the signal. Crypto volatility increasingly correlates with global macro events, suggesting maturation into a recognized asset class. Federal Reserve policy announcements move crypto markets. Inflation data affects Bitcoin positioning as digital gold. Geopolitical instability drives safe haven flows. This growing correlation with traditional macro factors indicates that crypto is integrating into the broader financial system rather than operating in isolation. Integration brings volatility from global events but also legitimacy, infrastructure, and eventually stability. The price of joining the global financial system is inheriting its turbulence. Options markets reveal how traders price crypto volatility through the volatility smile, a graph showing implied volatility across strike prices. Bitcoin's volatility smile is extreme compared to traditional assets, indicating traders expect significant tail risk in both directions. This isn't irrational fear, it's market participants rationally pricing structural volatility into option premiums. The smile shows professional traders acknowledge and charge for volatility rather than denying it. Understanding this pricing helps investors calibrate their own expectations and strategies. Metcalfe's law states that network value grows with the square of users. As crypto networks expand, more holders, more merchants, more applications, they become harder to move. A $1 billion market cap moves easily, a $1 trillion market cap requires massive capital. Bitcoin's growing network effect creates natural stabilization over time. More participants, more liquidity, more use cases all contribute to reducing percentage volatility. The path isn't linear or guaranteed, but the directional trend toward stability through growth is mathematically predictable. Central bank digital currencies represent a parallel path toward stable cryptocurrency. China's digital yuan, Europe's digital euro exploration, and dozens of other CBDC projects aim to combine cryptocurrency technology with fiat stability. These centralized stablecoins won't replace decentralized cryptocurrencies, but their existence and adoption will create infrastructure, regulatory frameworks, and user familiarity that benefit the entire ecosystem. As digital currency becomes normal, cryptocurrency volatility becomes less shocking and more accepted as the price of decentralization. Sarah's portfolio recovered and then exceeded its previous peak, but more importantly, her relationship with volatility transformed. She stopped viewing price swings as personal attacks or system failures. She recognized them as natural phenomena in a young, structural market. When prices dropped 30%, she didn't panic. She understood leverage cascades, thin liquidity, and sentiment amplification. When prices spiked, she didn't assume permanent ascent. She recognized reflexivity and speculation. The myths that once confused her became tools for understanding market dynamics. Let's revisit the 5 myths we've busted. Myth 1: Crypto is purely speculative with no value. Wrong, it's a young market with real fundamentals finding price discovery. Myth 2: Whales control everything. Incomplete, liquidity structure matters more than individual holders. Myth 3: No regulation means chaos. False, fragmented regulation exists and creates its own volatility. Myth 4: No fundamentals exist. Incorrect, network metrics provide real data. Myth 5: Volatility means failure. Backwards, volatility accompanies growth and maturation. Understanding what's false reveals what's true. The actual drivers of crypto volatility are structural and addressable. Fixed supply meeting variable demand. 24/7 global markets without stabilizers. Extreme leverage amplifying moves. Liquidity fragmentation across exchanges. Information asymmetry and insider advantages. Reflexive relationships between price and fundamentals. Unstable correlations with traditional assets. Social media sentiment amplification. These aren't permanent features, they're characteristics of market youth. Each is gradually moderating as infrastructure matures, regulation clarifies, and institutional participation deepens. If you're considering crypto investment or trying to understand losses, reject the comforting myths. Crypto isn't failing because it's volatile because it's young. Volatility isn't manipulation, it's structure. The path forward isn't avoiding crypto but engaging it with appropriate strategy, position sizing that survives maximum realistic loss, time horizons measured in years not days, dollar cost averaging to exploit rather than fear volatility, emotional discipline to avoid panic or euphoria. These principles apply to all volatile assets, but crypto demands rigorous application. When will crypto volatility normalize to traditional asset levels? Honest answer: decades, not years. Bitcoin may reach stock market volatility levels in another 15 to 20 years if adoption continues. Some cryptocurrencies may never stabilize if they fail to achieve sustainable use cases. Others might stabilize faster through stablecoin mechanisms or centralized control. The timeline depends on regulatory evolution, technological development, institutional adoption, and macroeconomic integration. Patience is mandatory. Anyone requiring immediate stability should avoid crypto entirely or use stablecoins exclusively. Perhaps the most important insight: for some participants, volatility is feature, not bug. Traders profit from price swings that would destroy long-term holders. Options sellers collect premium from volatility. Arbitrageurs exploit price differences across exchanges. These participants provide liquidity and price discovery precisely because volatility creates opportunity. A perfectly stable cryptocurrency might be better money but worse investment, worse trading vehicle, worse speculation instrument. The ecosystem requires volatility at this stage. Stability will emerge when growth slows and maturity arrives. Most crypto volatility victims suffer from education gaps, not market dysfunction. They enter without understanding market structure, position sizing, or risk management. They believe myths instead of seeking structural explanations. They panic when informed participants act rationally. The solution isn't avoiding crypto, it's education. Understand what you're buying. Know why it moves. Recognize your own psychological biases. Size positions appropriately. Invest time horizon that matches volatility profile. Education transforms volatility from existential threat to manageable characteristic. Sarah's journey from devastation to understanding reveals the path forward. Her initial losses came from believing myths that crypto should be stable, that volatility signaled failure, that the system was rigged against her. Her recovery came from rejecting those myths and understanding structure. Young markets are volatile, volatility creates opportunity and risk, and success requires appropriate strategy. 3 years later, she's profitable, educated, and calm. The market didn't change, her understanding did. That transformation is available to anyone willing to look past myths and see structure. Crypto volatility will decrease over decades as markets mature, infrastructure develops, regulation clarifies, and institutional participation deepens. It won't disappear, no asset class completely eliminates volatility. But the 100% swings will become 50% swings, then 20%, gradually approaching traditional asset volatility. This maturation process is inevitable if crypto survives, but survival isn't guaranteed. The assets that reach maturity will reward patient, educated participants who sized positions appropriately and maintained discipline through volatility. The question isn't whether to engage crypto, but how. The final truth about crypto volatility: its rational response to structural conditions, not irrational chaos. Every dramatic price swing has explanations rooted in market structure, participant behavior, and information flow. Understanding these explanations doesn't eliminate volatility, but it eliminates confusion, panic, and mythology. You can engage volatile markets successfully if you respect their structure, size positions appropriately, extend time horizons, control emotions, and continuously educate yourself. The myths we've busted today: speculation, whales, regulation, fundamentals, failure, kept people confused and vulnerable. Now you know better. Now you can act accordingly.